Hi, my name is Brenton Harrison with Henderson Financial Group, and we're here to talk about why physicians and dentists should be wary of student loan forgiveness. Let's get started. If you're a young physician or dentist and you owe just a mountainous amount of student loan debt, you're probably pretty familiar with the term income driven repayment plan. These are repayment plans offered by the federal government that rather than making you pay an amount needed to actually pay your loans off in full each year, you're instead allowed to pay a percentage of what's called your discretionary income. It's typically a much lower amount when you have a large student loan balance. And I encourage you to go back to some of our older videos to see how they calculate those payments and the details of those plans. But in general, you pay a percentage of your discretionary income, and after 20 to 25 years, if there's any balance that's left on your loans, it's forgiven, which sounds great. If you have $300,000, $400,000 of loans, the prospect of having them forgiven seems like something that you shouldn't pass up. However, there's a big caveat with these plans that, for me, puts a large percentage of medical and dental professionals in two camps, and in both of those camps, I don't think them pursuing student loan forgiveness after that 20-25 year period is the right option for them. The first camp is you might be in a medical or dental specialty where you owe a tremendous amount in loans, but you don't make enough in that specialty on average to get to the point where you actually pay any relevant or any large amount of your loans off by the end of that period, which is a very dangerous thing to do, as you'll see in a few minutes. And the second is you might make so much where even with the loans, it could cost you much less money over the course of the time to, rather than paying them off under the federal government's plans, instead refinance them with a private lender. But I'm not going to ask you to just lean on my word. I'm going to show you some examples, and we're going to show some student loan simulations using a physician that we're going to call Dr. Jane Doe. And we're going to go two different scenarios that will show you both camps that I'm referring to. Let's get into it. So understand that as we go through these examples, while Dr. Jane Doe is a fictitious person, these are actually real loans that a physician friend of mine allowed me to upload into this system. I've scrubbed all their personal information, so it's now under Jane Doe. We are going to assume that she earns an income of about $55,000, assuming she's a resident or a fellow, and that she's single and started an income-driven plan, the pay-as-you-earn plan, in 2018, so last year. That plan calls for you to pay for 20 years until any remaining balances are forgiven, so she should have about 19 years left to pay in all of our examples. And let's look at her loans. She has 10 loans in total. She borrowed about 351,000 and has interest of $49,000 that's accrued on these loans. So she owes a little over $400,000. So she probably did post-bac or a master's program, probably went to a private medical or dental school, but she owes a little over $400,000. And they all are spread out over direct loans, which is good if she chooses to do public service loan forgiveness because only direct loans are forgiven under those plans. But when you owe over $400,000, you are what is called, in my definition, an ultra borrower. That's a very loose definition, but in my opinion, what it means to be an ultra borrower is you owe a mortgage amount in student loans. So if you have essentially a house payment that you have to make in student loan payments, in my book, you are an ultra borrower. Here's the problem with being an ultra borrower when it comes to student loans. We talked about these student loan payment plans and the ability to have them forgiven after 20, 25 years if you have a remaining loan balance. But what we didn't cover is the fact that under these plans, any amount that's forgiven at the end of those periods is treated as taxable income in the year in which it's received. So if you have $300,000, $400,000 of loans that end up being forgiven, which is very possible, you would be paying taxes as if you earned that amount in addition to whatever your salary was for this year. Now, consider the career of an early stage physician or dentist who may be in a medical or dental residency and owes $300,000 to $400,000 in loans, but is having their payments based on the income of $50,000 or $60,000. You may only be paying a couple $100 a month, which unfortunately isn't even enough to meet the minimum interest that's accumulating on your loans. And that's right, if you don't meet the minimum interest, your loan balance will be increasing during your training, which puts you in a position where you leave residency and fellowship owing more than you did when you left medical or dental school. Let's use a basic example from Dr. Jane Doe's loans to show why having her loans increase during residency and fellowship can actually make it really tough to attack that balance when she leaves. Remember, she owes about $400,000 worth of loans, and even though it's more than this, let's assume that she owes it at 5% interest. Well, $400,000 at 5% interest means that this year she's going to have $20,000 of interest accumulating on her loan. That's not 20,000 she would have to pay to decrease her loan balance. That's 20,000 she would have to pay just to meet the minimum interest and still owe $400,000 next year. That's over $1,600 a month. And what you'll find is that because of these income-driven plans that base her payment off of her discretionary income, she's not going to pay anywhere near that. You'll see in a few minutes that she's only going to pay about $300 a month or $3,600 a year, which means that even after paying that amount, there's still $16,400 of what's called excess interest growing on her loans. That's interest that her loan payment just didn't cover. And if she doesn't do anything with this, instead of 400,000 growing at 5% next year it will be 416,400 growing at 5% interest. And when you do that calculation, instead of 20,000 she would have to pay to keep her loan where it is, it's $20,820 of interest, and it keeps on snowballing and snowballing. Now, fortunately, some of these plans have something called an interest subsidy, which does help decrease the amount that increases on your loan every single year. As a matter of fact, some of the details for these subsidies between like the pay plan and the repay plan and the length of time that you're going to be in training can lead you to pick one plan that's more appropriate over another. That's another video for another day. But what I do want to get across is that because of the way these loans work and that snowballing interest, every single year, a larger and larger amount is getting added onto this loan, which makes it more and more difficult to attack the principal once she leaves. Now, why is all this so important? Well, we're showing you the impact of your loans possibly increasing during your training. And you're probably thinking that once you get out of training, you'll be making enough money that the payment that you make based on your discretionary income will not just be enough to meet the minimum interest, it will be enough to actually decrease the amount that you owe in loans. But you'll find that for many medical and dental specialties, they may never reach the point where they even meet that interest after training, much less have it go down. And for those people, they're setting themselves up to have a tremendous tax bill at the end of those 20-25 years because their loan was either increasing or staying put, and they're having a few $100,000 of loans forgiven, and thus a large tax consequence as a result of it being added on to their taxable income. That's the first thing that I want to get across in this video, that unfortunately we have to call a spade a spade. There are certain medical and dental specialties that on average simply don't earn enough to have this be an option that they should consider because of that potential tax bill that's coming down the line. To illustrate our example of Jane Doe choosing a medical specialty or a dental specialty that simply doesn't earn enough relative to her loan balance to make a substantial impact, we're going to look at two different scenarios. And the first one is going to be her choosing to be a pediatrician. The salaries that you see here are going to be pulled from the 2019 Medscape Physician Income Report. I'm happy to share that report with you. But we're going to assume, again, during residency that she makes about $55,000 with a 2% raise each year to represent that raise during residency and fellowship. But in 2022, she's going to start to earn $225,000. That is the average for that medical specialty in that report. So we're going to look up the payment plans that she has available to her. Remember, we had her on the pay plan with 19 years left before her loans are forgiven. And you can see a quick summary up here. We'll go into more detail, but after 19 more years, she's projected to have $426,000 of loans forgiven. That is more than she actually paid right now, which proves my point that she never reached the point where her income-driven payments were enough to actually reduce the amount of loans that she owed leaving residency. We can look at the details to see what happened here. You can see the years on the far left and then her projected monthly payment in those years. During residency, it's a little over $300 a month, as we said. And then after residency, it definitely increases. It jumps to about $1,700 a month and increases as her income increases all the way up to about $2,200 towards the end. And her loan balance, unfortunately, it takes 7 or 8 years before it stops increasing. So you can see 419, 438,000.
And it's not till that seventh or eighth year where you start to see it actually neutralize, where she's paying enough to have the interest stop increasing and increasing and increasing. And it does decrease a little, but never to the point where it goes below the amount she had when she left residency. Now, this $426,000 worth of loans that are forgiven is a very huge deal because remember, this will be added on to her $225,000 of taxable income. So, if you look at that, that would mean that she has a taxable income of about $650,000 in the year her loans are forgiven, even though she actually only brought home $225,000. That would, if it happened in 2019, it would easily put her in the 37% tax bracket, which would mean that the taxes on just the loans, not the taxes she would owe on her full taxable income, but just the taxes on that forgiven loans would be $157,000 that she would have to pay in one fell swoop that year. There's no payment plan for this. This is what will be due in 2037. So, you can start to see that this is the type of thing that puts her in a position where she has to understand that if there is an alternative to avoid this circumstance, to avoid having to write that check, she needs to look into that alternative very, very thoroughly.
And what is the best option to avoid it? Well, in my opinion, it's the Public Service Loan Forgiveness Program. You'll find a lot of misinformation out there about this program, and many people who are telling you that it's in trouble and it's going to go away or that it doesn't work. I'm not in that camp. I'm happy to talk to you offline to tell you why. And for me, if you're in a situation where you owe that amount and you're projected to have that big a tax bill, having a program that makes you pay towards your loans for half the time or more, the Public Service Loan Forgiveness Program is 10 years instead of 20 or 25, and has no tax consequence at the end. You simply walk away. There are no taxes on the forgiven loans under Public Service Loan Forgiveness. That's the option when you're in a medical and dental specialty that's in this scenario. If you're on track to have 300, 400 or more, you want to go for the option that allows you to pay for half the time with no taxable consequence. If you choose not to pursue public service loan forgiveness, then you're faced with the possibility of either radically reducing your lifestyle so that you can actually start to address those loans so that that tax consequence isn't as large because your forgiven loans wouldn't be as large, or saving up on the side to prepare for that tax bill. But my question would be, do you have enough income and enough ability to save to not only prepare for your own wealth, your own retirement, but also set aside another $100, $150, $200,000 just to give to the IRS at the end of 2025 years? If you can, kudos to you. But most people are not in that situation, and because of that, in my opinion, the most viable financial option in this scenario is public service loan forgiveness. Now let's go to scenario 2. Remember, we're using the same loans, we're using the same repayment program, but now we're going to make the income, or we're going to make Jane Doe make the income of an anesthesiologist as compared to that of a pediatrician. We keep her residency pay the same. She's making about $55,000 with a 2% raise until the year 2022. Now she's going to be making $392,000 as compared to a little over $200,000 as a pediatrician, and that amount will continue to increase at 2% as well to keep up with the cost of living. Let's see what that does to the payment plan and also the projected taxes. Now we switch over to the pay plan, and if you remember with the pediatrician, there was a whole section up here that listed the projected tax burden, the amount that will be forgiven, and you see none of that here. And that is because under that income, she would actually be predicted to, or projected to, pay the loan off in full. There would be no loan forgiveness. And let's look at the details and you can see why. Remember, she's making the same as a resident as before, so she's paying a few $100s a month during residency. But in 2022, that payment definitely leapfrogs. She starts paying a little over $3,000 a month to reflect the payment that she will be making as an anesthesiologist, and that increases as she makes more. The payment increases until towards the end of the program, she is paying a little over $4,100 a month. You can actually see in the earlier years with that outstanding balance, it still goes up a little bit. $419,000, $438,000, $456,000. And that's because at this point she is still not paying the amount that would be needed to cover the interest on her loans. But when she starts making the full pay of an anesthesiologist, it immediately starts to go down. $441,000, $425,000, until in the year 2037, so not even 20 years after she started, she's projected to have a balance of $0. She's paid her loan off in full. Now, does this mean that because she's not going to have any of the problems with the tax burden and she actually is projected to pay her loans off, that she should stay with the federal government? Not necessarily. And as an example, let's go back to those loans that we used to calculate these payments. If you look at the interest rate, it may be a little small to see, but the interest rate on this loan is 6%. The interest on the next one is 7%, 5.31. 6.31, 5.84, 6.84%. These are relatively high interest rates that she's paying on her loans. So let's say that she comes across a private lender, be it SoFi or Laurel Road or Credible. Not recommendations for any of those companies, but maybe one of them comes along and says, hey, we'll refinance your loans and we'll let you pay us back at 5%. Is that an offer that the anesthesiologist should consider? Absolutely, because if she pays it off at a lower rate over the course of 19, 20 years, she's going to pay less towards that loan because of the interest rate savings she would get by refinancing, as opposed to sticking with the federal government and not even getting the benefit of having a loan forgiven. There's a lesson here for each category that we've covered today. If you're in the first camp and you're in a medical or dental specialty and you're simply not earning enough on average to make a dent in those student loans that you owe, you have to understand and be realistic about the fact that choosing to pursue loan forgiveness under these income-driven plans instead of pursuing public service loan forgiveness really is a life-altering decision. It will impact your finances in a major way for years to come. And if you choose to do that, you need to at least be aware and plan for a potential tax consequence that could be coming your way. But even for the second camp, where you're making a tremendous amount of money, even though you have a tremendous amount of loans, you have to understand that you may be in a position where you're paying enough that loan forgiveness doesn't make sense for you either. And it's worth considering some of those options you might get in the mail to look into refinancing those loans with a private lender. Again, none of these are 100% scenarios where every single person in this category should pursue the options that I'm saying, but it is something you have to understand when comparing the benefits of student loan forgiveness to some of the other options that you have on the table. I hope this video was useful for you guys. We're definitely going to keep sending them to you, and give us your comments, give us your likes, your shares to tell us what we can improve and what you'd like to see in the future. If you haven't already, subscribe to us on Facebook and YouTube, and there will be more to come. I'll see you soon.